Hey, everybody. Welcome to the What the Wealthy Do podcast, where we pull back the curtain on how the wealthy build wealth and show you how you can use those strategies on your personal wealth building journey. Hi, I'm your host, Stephanie Dorsey. I'm also the CEO and co-founder of Margins Capital, where we provide access to women and people of color to an institutional quality portfolio of alternative investments. Today, we are going to continue discussing the different, at least the biggest alternative investments that are available to invest in. Last week we talked about private equity. This week we're going to talk about her little sassy cousin, venture capital. And before we get started, you know the drill. This podcast is not intended to provide financial advice. However, it does provide financial education. So let's jump into it. So what is venture capital, or sometimes it's called VC? VC is a type of private equity that focuses on investing and taking a minority stake in early stage companies. Earlier stage. In plain language, it's basically investing in the company before it blows up, before it becomes a billion-dollar unicorn. So think Uber, investing in Uber before it goes public, Airbnb before it goes public, think Canva before it became the go-to design tool. So venture capitalists exchange money in order for equity or ownership in a private company before it becomes the company that everyone knows about. So if the company grows and ends up going public or becomes acquired by another larger company, those earlier investors make a lot of money, because the earlier you invest, the smaller the valuation, the bigger the pie that you own. But here's the catch. Most startups fail. And when I say most, I'm talking about 90% of startups fail. So you're making a bet. You're making a really big bet to invest in a startup. So your investment should pay off if it doesn't fail. Meaning, because most startups fail, when you invest in a startup, the risks are great. So that's part of the reason why so many venture capitalists make so much money when a company hits. So how does VC work? First, fundraise. You raise money from different individuals or institutions like pension plans, endowments, insurance companies, larger asset firms, and the like. And you pool those resources, and then you decide which companies you're going to invest in. All of those individual investors are considered to be limited partners in the fund, and the person or entity that manages the fund is considered a general partner in the fund. The general partner or fund manager is the one that manages the day-to-day, as well as identify the companies to invest in. They conduct all the due diligence, all the things. The limited partners in the fund are passive. We give our money to the general partner and we sit back and wait for hopefully our large returns to come to us. So the general partner, the second part, is building the portfolio of companies. So the way that venture capital works and what's literally accepted, is that 20% of the companies will become successful, and 80% of the companies that they invest in will fail. So obviously the goal is to hit home runs with every company, but they accept that that's just not going to be the case. So once the fund is raised, then the fund starts investing in different startups. They accept that the goal is that 20% of the companies will perform well, and they will make up for the 80% of the companies that will ultimately fail. The third thing is, once you construct your portfolio of different companies that you're going to invest in, the next thing you want to do is you want to support those companies. Because listen, you've invested in them as a fund manager. You want them to win. Like, I am going to try to make sure that everyone wins. So you need some introductions, you need someone to sit on the board, or you need some expertise for one big thing that you're undertaking or whatever. Then I am going to try to either give you that support personally or introduce you to someone that is going to help, whether it be an advisor, or if it's something more important, then maybe I will help you find someone to sit on your board, or I will sit on your board. This is not what Margins Capital does, but I'm just speaking generically. Me, you, all those pronouns. And then lastly, the next thing to do is exit, right? The goal is to help that company grow and grow and grow and grow to the point where it's acquired, and that's called a liquidity event, or it's so successful that it makes sense for it to go public. When you have that liquidity event, that's when the early investors and the VC cash out. Okay, so there are various stages of VC funding or investment, and not every VC firm operates at each level or in each stage. So there's a pre-seed stage. And so this is generally the idea stage. There are stories of people, mostly not Black, where someone just had an idea, and because of who they were or who they knew, they got someone to give them a couple of $1 million to figure out what to build, what to do, or to build that idea that they had. I was literally just watching the movie Swiped about the CEO of Bumble, who was former co-founder at Tinder. And again, it's a movie, but she basically got the money to found Bumble while it was just an idea. So there was a pre-seed investment that she got from the founder of Badoo. Then you have seed stage. So seed stage is, no, I have the idea and I built it a little bit. I have at least a minimal viable product that's out there where I have some paying customers. That's called traction. And so some people are really kind of like, oh, this sounds kind of interesting. And what happens is you build the thing, you get traction, and you realize like, okay, I need more money to really build this thing out. And that investment stage is called the seed stage. Then you have the Series A stage. So the startup really has traction. Like you have some revenues coming in, you have customer data. You're at the point where you're like, okay, I really know some things. I know exactly where I need to go. I know exactly what my customers want to see. And so Series A helps you scale. So you are at the point where I know exactly what direction we need to go in, but I need money to get there. I need money to hire more people and invest in more things so that I can give the people what they want. So that's Series A. And then Series B, C, D, etc. I've seen a Series G. I'm sure you've seen more. Each round is necessary to build and create more growth for the company. So that could be growing your core product. That could be doing a product expansion, so creating new products. It could be expanding into international territories. It could be building out a warehouse. But whatever, it's really just massive expansion. Your product is tried and true and you know what you're going to do, but you take on additional rounds of investment so that you can continue to really kind of blow your company out and grow it even further. So VCs make money in two ways. They make it by management fees. So again, as a fund, you charge a 2% management fee to manage the fund, and that 2% is charged on the assets under management. So if I raise $1 million from my fund, I earn 2% on that $1 million every year. It's not a lot. So 2% on $1 million is $20,000 a year. That's what I earn. But that's part of the reason why you see people raising $100 million funds so they can earn $2 million or more. But again, it's not that much. It seems like a lot, but it's not. But they really start to make money on, I hear like the third and fourth fund, and really after you start to earn what's called carried interest. And that is you get 20% on the returns that you get from your investments. So if you invest in a company and you end up making $1 million on that company, you as the general partner for a venture capital fund get to keep $200,000 on that $1 million, and then you give $800,000 to your LPs or limited partners. So the wealthy love venture capital because, again, the ability for outsized returns, when it hits, it hits. It really, really does well. Also, the ability to influence innovation. So if you are interested in space exploration, like you might really be into investing in companies that explore space, i.e. SpaceX, or in investing in companies that explore green technology because of the climate change issue and could be near and dear to your heart. So you have the ability to put your dollars where in alignment with what matters to you and invest invest in that innovation around that space. Diversification, there's an opportunity for you to diversify your investments. And then lastly, influence. Investing your money in a thing influences the growth of a thing or an industry, but also potentially you get to become an advisor for a company that you care about, or even sit on the board for that company. So the thing you really need to know about this space is you need to understand the risks. Again, I'm going to keep saying this, 90% of startups fail. And on top of that, which makes sense, 80% of the companies in a venture capital fund tank, or they don't have breakouts. They're not doing that well. So the odds are not in your favor, like the Hunger Games, but which is part of the reason why you just don't put your rent money in there, right? Like you only allocate a certain amount of your investment portfolio that makes sense for you and your goals and your risk tolerance to venture capital investments. You might want to consider invest in a fund if you are an accredited investor and you want to invest in venture capital, but you don't have an interest to do the work yourself, to find the companies to invest in and conduct the due diligence on your own and all of that. If you're not interested in that, but you want to invest in venture capital, then consider investing in a fund. And you don't need $1 million to start. There are platforms that enable you to invest in startups. Again, you want to be careful that you can do an appropriate amount of due diligence on the platform as well as the underlying companies on those platforms. And then you also start to network. If this is an area that's interesting to you, there are angel investment organizations. You can go to pitch competitions. There's literally an ecosystem for you to get plugged into wherever you live so that you can learn more about different startups in your area or different angel networks in your area that have access to different opportunities to invest. I don't name check anybody on this podcast because ain't nobody paying me, but I will name check Cap Table Coalition. It is an organization of Black and brown investors that get access to amazing companies to invest, like the real deal. And I have made, on behalf of Margins and personally, investments through Cap Table Coalition. So I recommend you plug in, join their newsletter, and you will start to see some of the deal flow that they have, and they share it. And you can decide whether or not you want to start to listen in on some of their fundraising calls, as well as they will send out pitch decks for you to review and just to build the reps up to determine how to evaluate companies that are raising money. So the big picture here is venture capital is how the wealthy invest in the possibility, how they invest in technology and innovation. They accept the risks, they understand the risks. And so you just need to, I will say this all the time, to thine own self be true. Understand what your goals are, what your financial position is, what your risk tolerance is, and those three things will inform if or how much venture capital should be included in your investment portfolio. All right, everybody, that's today's episode. Today we talked about venture capital, specifically what it is, how it works, the different seeds, and what you need to know before you decide to invest in venture capital. If you found this episode was helpful, please share it with a friend. Don't forget to like, follow, and subscribe on YouTube, Spotify, or Apple. And join us next week when we talk about commercial real estate. That is all. Deuces.